Welcome to the Multifamily Wealth Podcast. I'm your host, Axel Ragnarsson, and on this show, I dissect how seasoned multifamily investors started, built, and scaled their businesses. What's going on, everybody? Welcome back to another quick solo episode here on the Multifamily Wealth Podcast. In this episode, I'm going to be talking about what I see as the number one mistake that value-add multifamily investors make, and how you can avoid it and why you need to avoid it because the stakes are really high. This is something that I've done before. I've learned this lesson on a very small deal in a minor way. We've learned this lesson on some bigger deals, and it's just one of the most expensive mistakes that you can make as an investor. And what I'm talking about here, and it's going to sound like two mistakes, but they are they're very aligned in terms of typically one leads to the other or they happen in conjunction with each other. And that is buying a deal in a poor area where your business plan does not align with that marketplace. So one, buying a deal in a poor area, that's one mistake, right? That's very obvious. Everybody that's in real estate has heard that a million times. But the other piece of this is buying a deal and executing a business plan that does not align with what that market supports, with what that specific area supports. And usually these two things happen together. So in practice, this is somebody going out there and buying a deal in a C- area, right? A really, call it a rough neighborhood. And they have a business plan where they think they're going to take it to a B-class property. They're going to do all these nice renovations. They're going to, install granite, and they're going to do nice LVP flooring. They're going to do all this stuff. And they think that they're going to get a B-class tenant on the other end. But they don't, because the market doesn't support that. The area doesn't support that. The market isn't willing to pay for that. There's not the residents there required to find success in that business plan. And long story short, they do all this work and they're not paid for it. And this is something that happens all the time, especially with newer investors that are really optimistic about what they can do in a property. And they're really optimistic about an area, right? In this neighborhood, they think this neighborhood's better than it is. They think that there's more demand there for a higher quality product than there actually is. And typically what happens here is, and this is how this mistake manifests itself, is a lot of wasted dollars in CapEx. Obviously, right? You're spending all this money on renovations that the market doesn't want, need, or is willing to pay for. It's a ton of wasted time because you're spending all of this time doing this work, and therefore you have associated holding costs, associated vacancy, et cetera. And again, that the market's not willing to compensate you for. Completely unnecessary headaches because, again, doing a moderate to heavy value add type of deal, which is what we're talking about doing here, taking a property from a lower class to a higher class where, again, the market's not going to reward you for doing that. Takes a lot of time, a lot of energy, a lot of resources, a lot of attention to successfully try to even manage the process along the way. And that's time you could be spent doing other deals. That's money that you could spend, on other deals. And I think what people don't realize is that the opportunity cost for capital and for time is so huge. And you really need to be hypersensitive about where you're spending your time and where you're spending your money. And ask me how I know, because I do. We just wrapped up a property or just wrapped up selling a property where this was the case. Granted, there was a bunch of other headaches. We had a big insurance claim and we had a payout, and there was a whole other piece of this. But fundamentally speaking, we bought a property in a really rough area that we thought would support a different level of finish or a different type of product. And the market just didn't, right? Spent a lot of time, money, and energy chasing something that just wasn't there. And luckily it was my own money, right? I learned on my own dime. I never bring investor capital into something that I feel like is a little bit more speculative of a project. So this was my own dough, and it was an expensive lesson, but it was a worthwhile lesson. And one that's, I'm constantly reminded of because I see it happen to other people all the time. People ask me what they think of a deal, and maybe they're looking at a deal in a market that I buy in that I know really well, and they're talking about the rents that they're going to achieve. They're talking about the level of finishes that they're going to finish the property at, the renovations that they're going to do, their plan. And I'm like, dude, the demand's not there. Like, that's a rough neighborhood. You're not going to find somebody willing to pay that rent. And who cares about that level of finish? Because you're the outlier. That market isn't willing to give you the reward for doing all of that stuff. And it's usually, and again, obviously newer folks are the one that makes mistakes, right? I mean, that's normal, obviously. You learn and you make mistakes, you learn, et cetera. But new investors are so prone to making this mistake because oftentimes they're looking at things through an optimistic lens, rose-colored glasses. They're looking at the upside, the potential. They've read about everyone who's done this. You buy the property, you throw in the granite, the stainless, you achieve a higher rent, et cetera, et cetera. And it all looks great on paper until you actually go out there and try and execute it, because this is a messy, dirty business in the value add game. So be extremely hypersensitive about getting into deals in bad areas, one. But if you're going to get into a bad area and it's aligned with a business plan that's like, hey, we're in a tough neighborhood and we know it, and we're going to operate this property with full awareness of exactly what we're buying and where we're buying it. That's one thing. You can do that. People make money doing that. You can have a successful career doing that. That's fine. But it's when it's married with an optimistic business plan that requires you to turn over a ton of units, spend a lot of money on renovations, put capital at risk in the form of physical improvements. That's where you need to take a step back and really ask yourself, will the market reward me with higher rents, with higher occupancy, with a better quality of resident, et cetera, if I do all of these different things? And oftentimes the answer is, I shouldn't say oftentimes, so excuse me with that, but a lot of times in many situations, the answer is no, and the market won't do that. And there's also a lot of times where it will, right? There's plenty of banged up, crappy buildings that people have overlooked and not taken care of in good areas where this business plan is perfect. But there's just as many that are in bad areas where it doesn't make sense. So some ways to remedy this, right? Because let me boil this out, or boil this down to a few actionable tips and wrap it up with some tips. If you're looking at a deal that's questionable like this, you really need to get on the horn with some very active property managers and brokers and talk to them. I almost don't even want to include brokers in that, because brokers oftentimes also have a very rose-colored view of what can be done with a property, because they're not on the operational side and they don't know what actually happens post-close. Many brokers don't. The good ones do, but many don't. So let me actually remove them. You really need to speak with some just entrenched local PMs that manage in those areas and have honest conversations about what's possible. Big mistake I made on the deal where we lost our shirt was we chatted with a few PMs. A couple of them were like, yeah, maybe that would work. And then we had one that was gung-ho about it. And I heard what I wanted to hear. And that's oftentimes what we find in this business is we hear what we want to hear. And, again, I had an optimistic PM that wanted to work on the project. Great PM. I have nothing poor to say about them, but but they were they were also optimistic about what could be done there. And there's probably a piece of it that, they wanted to win the business, but you need to have this conversation with many people and listen to the ones that don't necessarily agree with your plan, because that is oftentimes not in their incentive to do so, right? If they're confronting you, especially in a position where they might win business, and telling you that, hey, this might not make sense, it takes a lot of guts to do that if you are them. So you need to listen as the investor. Another actionable tip here is to just really, really get granular on what's going on in that market and assessing what the demand is for these types of units, right? One of the biggest secrets, or one of the biggest things you can do is put up a for rent ad of a property that has been renovated, but use an address, not somebody's real address, not like an actual property address. Leave the address out, throw it up on, Facebook Marketplace, Craigslist, what have you, and gauge the demand for the unit that you are proposing to finish. Now, please do this carefully. You do not want to waste people's time. This is not something that you should be doing all of the time. You should do this maybe once and then get a sense for an area. And I almost feel hesitant to even recommend this because, again, I don't want you to waste people's time. But many investors out there do this. Many investors have had success. If you put up a property and it gets 50 inquiries, a bunch of showing requests at the rent that you're looking to achieve, at the level of finish you're looking to achieve, in the neighborhood that you are looking to execute this type of business plan in, well, then you get some validation, right? You get some validation from the market. Now, yeah, you're probably not going to know the quality of those interested parties from a credit score standpoint, from an income standpoint. You're not going to get that far, but at least you have some anecdotal data, and that's helpful in terms of making decisions here. And I guess lastly, again, you just really want to get into it with the, with brokers, with other service providers, with other investors that own in that area, and get a sense of what the market can afford and what the demand will be there for the proposed scope of work that you're looking to actually execute on at a property that you're looking to buy in a certain area. So to wrap this all up, if I were to boil down the number one mistake, the number one most costly mistake, and again, there's thousands of mistakes you can make. It's just buying a deal in a poor area with an overly optimistic business plan, because you're going to be you're going to be basically driving down your occupancy. Your vacancy is going to go up. You're going to be spending a bunch of money you don't need to spend. You're going to be spending a bunch of time on a project you don't need to be spending time on. And when it's all said and done, the market's not going to reward you for doing that. And that's not what you want to be. So hopefully this helps someone avoid making the same mistake. And if you enjoyed this episode, please consider leaving a rating and review for the podcast. Always appreciated. Thank you to everyone who has already done it. I think we're coming up on 250 5-star reviews, which is or ratings, I should say, which is great. Hopefully we can hit that in the next couple of weeks. But thanks again for listening, and I'll catch you guys on the next episode. Thank you for listening to this episode on the Multifamily Wealth Podcast. If you learned something new during the show, please consider sharing this episode with a friend, family member, or business partner, or just leaving a rating and review, as it helps the show get noticed by more folks. Catch you next week.